analyze the present value, future value, the impact of the financial markets to the system. If you have any question regarding to this topic, I will answer or we will go through. As I said to you, in economics, there is financial sector and real sector, so-called the goods markets and paper markets and the financial markets. The markets that we are dealing with, the financial sector, the bonds, stock papers, and the other stock papers, money market, which is creating the capital to the system. And the financial market is becoming very important because if you don't have enough capital in your hands, you cannot realize any entrepreneur or any business. Due to this reason, financial sector is becoming very important from this point of view. As I mentioned to you in the former classes, financial sector and the financial ability of the country is becoming important for increasing the GDP growth, gross domestic production, and the entrepreneurship, so-called the financial sector, which creating credit to the entrepreneur for realizing some business activity, some entrepreneurship. Finance is the field that studies how people make decisions regarding the allocation of resources over time and handling a risk, which means you have always risk when you are having some financial abilities and financial problem. And when you have some credit for realizing your businesses, your activities, you are exercising some risk because every economical activities have some risk and you cannot remove this risk from the system. And this can be minimized, you can reduce this risk, but you cannot remove it from the system. And from this point of view, we are going to exercise the capital, how we are going to generate some value, some interest or some, let's say, capital with this money, with these resources, with this financial credit that we are having. If you are able to estimate the impact of your business or your value of your existing in your hands, you can do some businesses by doing some estimation using the present value calculation or the future value estimation for being able to determine the impact of your capital to the future or your giving up value, whether it is better to give up to get in the future. You are determining because some people delivering some capital to the banking sector, and this means you are not using your capital present in current days and you are letting it to use in the future. And this should be determined whether it is profitable or not. I hope you are understanding. Savers who are ready to deliver this capital to the system expecting some interest, some real value, some interest rate, some real interest rate for getting in the future. And this is the realizing the maturity date of this capital. And from this point of view, you are wishing to know whether you have to give up this capital to the future usage or you want to use it in the present. As you know, currently we are exercising heavy inflation, which reduces our capital's value. And when you are holding your capital in Turkish lira, probably you are losing much if you are delivering it to the future, because even if you are getting some 10%, 15% interest rate with this capital and the exact depreciation of this currency, or the exactly the inflation which affecting and reducing its value is more than 15%, let's say 20%, 30%, 50%, which is currently we are exercising above 50% sum, then this will then reduce your existing value. Let's think about you have $1,000 and you have in Turkish lira currently, let's say €100, isn't it? Or if you have $10,000, you have 1,000 euro, which was in 2 years ago approximately 3,000, maybe 3,050. Therefore, this depreciation of the Turkish lira creating too much problem to the entrepreneur who are holding the capital in their hand and wishing to enlarge and increase the business with this currency, which is not very popular currency for using in the investment or in the banking sector, because Turkish lira is very heavily depreciating and it is not good to hold the Turkish lira in the bank for long run, let's say, investments, for long run some savings purposes. The present value will help us to determine this estimation. Receiving a given sum of money in the present is preferred to receiving the same sum in the future. This means either you are estimating the future value of this capital that you are holding now in your hands, or you will have used it currently and you will determine whether it is better to give up to deliver to the future. This is the important point in this direction. In order to compare values of any time points, will gives you exact information about this calculation. The firms undertake investments projects if the present value of the project exceeds the cost. As you are understanding, cost and benefits of this capital is always important, because we are trying to have some beneficial analysis, which means the cost is becoming less than its benefits, then this will then create or generate some profit. And from this point of view, it is creating some important capital to you for the future purposes, because your capital will be very important for your businesses. And if you are not able to determine what to do with this capital, or how much money you want to invest, whether it is going to be profitable. Yes, please.
I'm sorry, like for right now, I am out and my phone battery is almost dead. So I wanna leave the meeting now. After I will watch your lectures online in your YouTube.
Okay, then. Thank you.
Thank
See
you,
you
sir.
then. Bye bye. Let's consider the present value estimation, which is given here. The PV is here the present value, X is the amount of the capital, and R is the interest rate, and N is the time period which we are going to estimate for this capital. And when we are going to determine its present value, we are going to calculate with this example for bringing to your attention, for making you clear understanding. If that needs $20,000 in 10 years and can invest what he has for 5%, let's find out how much he needs to invest today. $20,000 for future we are estimating, and we want to know how much we are going to invest from present. If it is 20,000 expected in the future, then you are going to put the 20,000 as a capital, and you will then use this with the present value, which is 1 plus 0.5, which is the 0.5 interest rate, will be calculated for 10 years. Then when you are going to estimate this value with this calculation, with the given formula here, because X will be divided to the 1 plus R, which is power of N, then here you are going to have 20,000 divided with the 1.6289, which is estimated 1.0.5 for the interest rate, because 1 plus R is the formula, will be calculated with the N, which is the period. Then after you are using this power of button in your calculator, you will get this results 1.62 for the 10 years interest rate estimation. And then you are going to divide this 20,000 to this calculated interest rate, and this will then gives you $12,278 is required for this debt. Her debt is very happy to hear this, because it is not too much, but we are calculating, as you observing, with dollar, and dollar is very fixed, very strong currency, and it is not depreciate and stagnate regarding to the other currencies easily, as Turkish lira or as Naira in Nigeria. Therefore, when you are holding such a strong currency in your hands, this will help you for estimating its impact to the system, or to your capital, or to your business. Present value formula, as I said to you, is the present value will be calculated with the future value divided to the 1 plus R power of N, which is used for the former example. Then future value is then the amount of money in the future that an amount of money today will yield given prevailing interest rate is called the future value. Then vice versa, we are going to replace or put the formula to the other side, and letting the future value alone for finding the future value, as it is given here. Future value is then is present value multiplied with the 1 plus 0.5 with the given example here. Let's imagine the donor puts $100 in the bank for 5 years at 5% interest, and plug that in the equation. When we are going to put this into equation, then you will see this formula easily. The future value is equal to then the present value multiplied with the bracket 1 plus real interest rate or interest rate in the bracket will be the power of 5, or will be the power of N. Then N is the year for this example used, and 100 is the present value is estimated, and we are going to calculate the future value in 5 years. Then we are going to put again this equation. Then future value will be then equal 100 multiplied with 1 plus 0.5, which is the interest rate, is the power of 5. Then when you are going to calculate again this bracket 1 plus 0.5, which is 1 over 0.5, power of 5, will gives you 1.2762. And when you are going to multiply this with the 100, then you will have 127.62, which is the future expected contribution for this capital. If you have any problem with these examples, please ask me, then I will repeat you. If you don't, then I will go further. Then future value, as I said to you, we are going to use a little bit complicated now, because we are going to estimate now the period which is put into the percentages, and in the period of time that you are going to calculate with this example. A is the cash flow, and R is the period interest rate, and N is the period which we are using. Then you are going to calculate this for the future value for the some little bit complicated or difficult estimations. We are having here an example, as you are seeing, the cash flow which is given for $1,000. If you know, or sorry, how much you can invest per period for a certain time, the future value of the ordinary annuity formula is usually for finding out how much you would have in the future by investing at your given interest rate. If you are making payments on a loan, the future value is usually determined the total cost of the loan. Let's suppose this example which is given here, $1,000 is the A is the amount of capital is going to be used, and this is the period which is given here, 1, 2, 3, 4, 5, and then payment of this is going to be asked to you. Then to calculate the future value of this annuity, we have to calculate the future value of each cash flow. Let's assume that you are receiving $1,000 every year for the next 5 years, and you invested each payment at $5, 5%. The following diagram shows how much you would have the end of this 5 years period, where you are getting every year $1,000. For calculation, this, as you are observing, is a little bit complicated because you are now using the yearly contribution $1,000 and adding this 5% interest rate to this summation. Then you will get this answer 1,000 times 1.0.5, which is going to be for 1 year for the first year, and the second year 1,000 times 1.0.5 with 5 years again is going to be 1,050 for the second year to third year, so-called 1,000 times 1.0.5 is going to be calculated 1,202.5, and for the third year is going to be 1,000 times 1.5, which is multiplied, and power of 3 is going to be 1,157.6, and 1,000 for the fourth year, 1,000 multiplied with 1.0.5 power of 4, then will give you then 1,215.5. When you are going to add this all together, you can do separately this, then you will have 5,525.64. But when we are going to use this with this formula where we are having, you don't need to do this calculation for separately. Then you are going to use this formula where it is given to you C multiplied 1 plus I, the interest rate, power of n minus 1 divided to the I. Then you are going to put the equation $1,000 multiplied with 1.0.5 power of 5 minus 1 divided to the 0.05 for the interest rate, and you will get the answer easily, which is 5,525.62 with this simplest future value estimation. I hope you are understanding what I meant. The former one was calculated separately, and we are using this future value formula and estimating the same answer, which is easily helping hand for estimating this kind of calculations. If you have any question, you ask me. If you don't, then I will go further for the next slide. You have any question, or is clear? Is it clear?
Sir.
Yes or no?
Sir.
Yes.
Can you hear me?
Yes, I'm hearing.
So basically the second one, it's just a summation of the first one, right?
Yes.
Okay. Okay,
Yeah,
thank you.
This one?
Yeah, the second one.
You mean on this slide or the last slide?
Yeah, on this slide.
Yes, you are going to calculate separately every year, don't you see? The first year is going to be calculated for the fourth, because you are starting from the fourth year. You're going to start with the 0 and go to the first year. This is present value in 0, and you go to the first year, then second year, then third year, then fourth year, and then fifth year. Fifth year, of course, you are going to get the value, which is not generate anything, because you are not going to put the fifth year into the equation, because you are going to start in the first year, which is calculated for 4 years, how much money you will get in after 4 years. And in the second year, you are going to calculate the 3 years summation of this capital, how much you are going to get with the $100,000. And the third year, you're going to use again for this 2 years interest rate, which is calculated here. But there is no need to do this. There is simplest way, as I said to you. You use this formula, which is given to you here. Future value is equal to C, which means the $1,000 or the yield or the capital that you are using, the cash that you are holding in your hands. Then is going to be multiplied with the 1 plus I, which is the interest rate. and n is the period, and minus 1 will be used for this formula and dividing this to the interest rate again. And when you are using this formula and applying to this example, then you will have this easily example and outcome and the result. And $1,000 will be multiplied with the bracket, in the bracket 1 plus 0.5 power of 5, because you are going to estimate this capital or cash for 5 years, and then you're gonna subtract it from 1 and dividing it to the interest rate. And when you are calculating this for the given example, you will get this 5,525, which is estimated separately in the former slide. I hope you are understanding, because there is no need to calculate separately. You are using this for calculating all together with this formula, future value and present value formula. Okay? Is it clear?
Yes, sir. Thank you.
Okay. Again here, now we are going to estimate the present value. Are coming from future to present, because the former one was the future value, and now we have the present. And as it is given here, you are gonna start from the 5th year, which is estimated, and go to the present. Either you are going to show or you are going to do the first year, and the first year, as I said to you, 1,000 divided 1.0.5 for the first year is going to be 952, and then you go to the second year is going to be multiplied 1,000 will be divided to the 1.0.5 multiplying to the power of 2, or calculate for the power 2, then you will get 9,500 something, which is not very easily seeable. Let's increase it. Yes, I can see 9,007. And then you're gonna calculate for the third year, then it's going to be 1,000 divided 1 plus r, which is 1.0.5 is power of 3. Then it's going to be 863. Then for the fourth year, you're gonna calculate 1,000 divided 1 plus r. I mean, cash flow A divided to the 1 plus r is 1,000 divided to the 1 plus r is 1.0.5 is power of 4. Then you're gonna get 822, and then you're gonna calculate for the fifth year is 1,000 divided to the 1.5 for the fifth power of. Then you will get 783. When you're gonna add this all together, then you will get 4,329 for this given example. But as I said to you, you don't need to do this. You can calculate with the present value formula, which is given to you. And as you are observing here, when we are going to put this $1,000 with the formula, which is given here, the present value formula is given here, which is a little bit different from the other one. Now you are going to subtract 1 from the interest. As you see, the former one was 1 plus I power of n minus 1. But now we are going to calculate 1 minus 1 plus I power of n divided to the interest rate. Therefore, this will then gives you the present value, because you are going to determine the present value of the fifth year estimation. Then you are gonna put this $1,000 as a cash, and then minus 1 plus 0.05 is the interest rate, power of 5, because the power of 5 is calculated in this example, is gonna divide it to the 0.05 for the interest rate, and this will then gives you 4,329.48 for the present value, which you are going to estimate the expected value of this $1,000 when you are going to use in the present. Is it clear?
Yes, sir. Yes.
Okay. This is then the rule of 70. You're gonna estimate again the future yield interest for the capital, and this is also very a good example for being able to understand how it is affecting and changing the interest rate of the people's let's say capital. According to the rule of 70, if some variable grows at a rate of X% per year, then the variable doubles it in approximately 70 over X years. This is how it is going to be estimated roughly. This is not the exact value, but roughly you can use this formula 70 over X for estimating the future expected value in a given period, time period. For example, you have 15% interest rate and you want to know how many years later your money will becomes double. Then 72 divided to the 15 is going to be 4.8 years later your money will be double. As you see, you can use either 70 or 72. It depends how you are going to calculate it, but it is almost giving the similar calculations and similar results. And you are understanding in 5 years, roughly in 5 years, you will double your money if you are putting for 15% interest rate, which is expected outcome. And the exponential growth and the rule of 70, there is an easy way to figure out how quickly something will double when it's growing exponential. Just divide the 70 by the percentage interest increase or expected outcome, and you got the doubling time. The rule of 70, as I said to you, is 70%, 70 divided to the percentage of this growth, which will double it in a given time. 70 will be doubling time, is going to give you the growth, vice versa, when you are going to replace the nominator with the denominator in the given example for the calculating either doubling time or the growth percentage rate. And the example here, if you hear that the population of your town is growing by 2% per year, that means it will double in just 35 years. 70 divided 2, because it is 2%, then will gives you 35. Then it is expected in 35 years you will get the double population in your town. It works in reverse to divide 70 by the doubling time to find the growth rate either, as I said to you. If you hear that US population is due to double in 70 years, you know that it's increasing at 1% per year, isn't it? Because you know that you are going to divide it to the 70, and 70 to 70 is 1%, and 1% will give you the growth rate, which is very easily estimated. And it's amazing that just a 1% annual increase can cause doubling and increase in 70 years, which is very huge amount of population growth. Therefore, the population growth should be taken under control. Otherwise, we cannot manage the sustainable development in the economy. Population growth and the GDP or real GDP growth must be balanced for increasing sustainable enlargement and development to the economy, to the country. Otherwise, we are observing in Pakistan, in India, in China, in Turkey, some parts, very huge amount of population growth affecting and reducing the welfare and increasing the poverty. As you are observing, as much as the people's growth and the population growth is very faster than the growth rate, this will cause poverty. That's the reason developed nations already taken under control this population growth, and they are taking some immigrants from the other countries for balancing this growth rate to the economical growth, because if your population growth is not sufficient for balancing this economic growth, you will reduce your economical growth, and this is not good for the economy. And vice versa, in China, they put the one-child restriction to the families. Per family, per one child will be was accepted up to the 2020, I think 2050 somehow. And it is the reason because Chinese population is very faster growing, and it is not desired for enlargement. You know, China is the second best economy in the world, but the population growth and the people there are very crowded, and results of this, the welfare distribution is not very fairly realized. The per capita, per income per person is very limited, and it is not accepted, because You are not developing as Finland, as Austria, as Switzerland, because in those countries the population growth is very limited, and the capital which is delivered, which is surplus, which is in surplus, can be distributed very highly to the population, to the people, and per capita, per person, per income is very high. And in China, it is very low. It is only $1,000, 1,200 somehow, because people getting $50, $100 per month, and this is then because of this crowded population and community. Risk management is also very important in the economy. As I said to you, a person is said to be risk averse or risk free if she or he exhibits a dislike of uncertainty. That's how it is introduced to you, but in the normal conditions you are of course always having this risk, and you cannot reduce and remove this risk from your agenda. You can minimize your risk, but you cannot exclude it from the agenda. Therefore, as much as you are reducing your risk by buying some insurance, by doing some other diversification in the business, or some other options which we are going to introduce to you, will then reduce your risk in your businesses. Individuals can reduce the risk by buying insurance, by diversifying their production, which means a variety of products will be introduced to the market, and this will then enlarge and reduce the risk in this direction. Or you may accept lower return on your investment, because a higher return is always risky, but lower return is more acceptable because it is not highly risky business, because lower return in the banking sector either or in any businesses can be easily covered. But if somebody promised you 50% interest or 50% return for your business, be careful with this investment, because nobody delivered to you 100% or 50% return in 1 year. Therefore, mostly the spam or some illicit, black businesses or corrupted businesses always realizing and promising such return, such interest, such profit to you, and usually they are bankrupt. They are not able to deliver it in a year. And this is not good for your business, because you will exercise problem. The risk aversion is given here. You are observing as much as the wealthiness increase, the utility becomes flatter and reduced. And if you have $1,000 and you are getting highest return, highest utility, and as much as your return and your wealthiness enlarge, your utility is becoming flatter and reduced. This is because you are not able to satisfy with much money. If you are holding $1,000 and you had in the former month, nothing, this $1,000 probably fulfill your all nutrition, and you fill up with feeding yourself, and you enjoy shopping or whatever it is as a person alone. This will then the highest utility for you. But when you are getting the 2,000, the 3,000, the 5,000, or let's say the first million, the second million, the millions will be increased in the bank, but the utility of this money is not equally distributed, because your wealthiness is enlarged and increased, but your utility from this capital is not the same level. It is decreasing, as you are observing. As much as your utility is becoming higher, your wealthiness enlarge more than your utility. And at the end of the day, you will become zero utility. As you see, it is becoming to the inverse U-shape, and top of this, you have the highest utility where it is the maximum point, and after this maximum, the utility becomes negative if you continue to draw this figure, isn't it? Therefore, utility becomes less and less as much as your wealthiness and your currency and capital enlarge and becomes more. Similarly, the risk is also becomes lower with this related capital. If you are startup business and you have a limited capital, your risk is much than the people who are holding too much capital in their hands. You may lose your capital with this startup business, but not that much as the newly entered startup businessman. Therefore, the risk averse is important. One way to deal with the risk is to buy insurance. As I said to you, you can secure your car by buying insurance, or you can secure yourself by buying insurance for your body, for your legs, for your physical parts. Or you may risk, you don't want to risk your house, then you buy insurance for your house. Much more, murders in America realized with this insurance, where there are people getting insurance for their body, for their healthiness, for their health. Let's say I will insure myself for $200,000, and if somebody knows that you got this $200,000 for yourself as a health care, if it is in your family either, they will enjoy to do something. Therefore, it is sometimes risky for such unpleasant, bad aimed people. Risk-free is realized especially for the businesses, because when you are covering your business with the insurance, you will get it back if something's happened, if any unexpected fire or any unexpected loss realized in your businesses. You may diversify your risk. As I said to you, you can enlarge your variety of your products for being able to reduce your risk. Let's say you are producing lemonade or orange soft, organic, inorganic, risk, sugar-free, sugar added, multi vitamins on such varieties can be enlarged and increased in business. If you are the producer of juice in the market, then you will enlarge your products and diversify it, and the variety of products will then reduce your risk, because any of this may become undesired. The demand capacity will be low, but the others will be high. Then this will cover your risk and this will cover your loss. Therefore, you will direct and enlarge your business with this profitable business. That's the reason in the economics we are always starting our sentences, don't put all the eggs in the same basket, because when you are putting the all eggs into the basket, and if the basket is not proper function and something's happened, then you will lose all eggs. Therefore, you have to diversify and put your eggs or your capital to the different financial assets and financial intermediaries. Then this will then reduce your risk in the business. I hope you are understanding what I am talking about. And idiosyncratic risk is the risk that affects only a single person, that uncertainty associated with special companies. Therefore, idiosyncratic risk is dependent to the personal risk, and it's uncertainty associated with the specific companies where you are dealing with. And the aggregate risk is the risk that affects all economical actors at once, the uncertainty associated with the entire economy. Therefore, Idiosyncratic risk is dependent to the one person risk, and aggregate risk, as you are understanding from the word, aggregate means total, is depending to the whole economy. Therefore, aggregate risk is affecting the whole. For example, if we are having here the pandemic and coronavirus, which is affecting the whole parties, this is the risk averse, and this is then the risk reduction must be concentrated to this global market, not the person or not the sector. Therefore, all parties and actors and the parameters should be carefully treated for reducing this risk, which is affecting the all parties, the supplier, the producer, the let's say nutrition sector, the hotellerie, the in construction, the healthcare, the hospitaling, the tourism sector, the employment, everybody is affected here. Therefore, you have to cover this unexpected, let's say, pandemic, which is affecting and increasing the risk in global economical or in the countries as a whole. Therefore, this kind of risk is much more dangerous than the idiosyncratic, because idiosyncratic affecting the person, which is also important for you as a person, but aggregate risk is affecting the whole. Therefore, you have to do the necessary applications and let's say sanctions against to these unexpected problems or risks, which cannot be covered easily. Diversification cannot remove aggregate risk, as I said to you, because it is aggregate level. And when we are drawing this diversification, as I mentioned to you, it is coming to this is then the risk standard deviation of the portfolio returns given to you on the y-axis, and on the x-axis, it is the number of stocks in portfolio is given to you. And as you are observing, as much as you are enlarging this portfolio, this will reduce your risk, because regarding to your capital enlargement, your risk factor is enlarged and increased and reduced. And the risk standard deviation portfolio return is becoming lower level as much as this portfolio enlarged and increased, but not removed. It becomes somewhere else at 20, from 49 to 20. The risk is reduced, decreasing level, realized, but the idiosyncratic risk is stay intact. As you see, the personal risk stay always there, but the below 20%, this is then the aggregate risk, which is affecting the whole parties. As I mentioned to you, this diversification can handle it easily, but not remove the risk from the agenda. Therefore, you have to learn how to manage it and how to handle it for reducing it. It depends, either you are going to buy insurance, by diversifying your risk, you may create some reasonable return and reduce this risk, but you cannot remove it from the agenda, because you know that the business is always risky and always having some risico for the businessmen. That's the reason the entrepreneurs are limited, are not too much. Most of the startup business disappeared in 2 years. So-called, let's say, 80% of the startup businesses collapsing or becomes bankrupt or disappear from the market, because they are not able to control their ability and their vitality. And this is not easy. As I said to you, if you are having a limited capital, then you have to take care of your capital and don't jump up to the business easily, where they are having large-scale businessmen and strong, powerful rivals who are easily beating you from the system, from the market, because risk factor is always existing. And for those firms who are holding too much capital and too much stocks in their hands, will not affected from this kind of risk, where they are reducing, for example, profit to the minus, to the lower level, for eliminating you from the system. You are in the business and you want to sell something, to profit something, but these large-scale firms may reduce their sales, their prices, to the lower level for eliminating you from the system. And this is the big issue, and we cannot easily solve it when it is dependent to the startup businessmen where they are having limited capital. People can reduce the risk by accepting lower return, as I said to you. And this is coming from the promise, as I mentioned to you. If somebody promised you to give you 50% profit or 50% return at the end of the maturity date, don't trust these people. Or if some banks, some newly founded banks, talking to you or promising to you 50% interest rate or 70% interest rate, don't take care seriously. Then take it seriously, because nobody can offer you in a short period of time such high profit. Maybe they will try to profit or deliver it, but it is very difficult, very, very risky business. And if company is 100 years founded or 200 years existing in the market, and this is reliable market and reliable company, then you may think about it. But if it is for 2 years in the market, then there is no need to do such wrong investments. Trade-off between risk and return, as you are observing here, the risk standard deviation is given on the x-axis and the return is given. As much as you are observing no stocks, then the return is around 3%, which is given to you 3.4%. And when you're gonna go up to the second level with the standard deviation risk, which is increased, and the stock is becoming 25%, and then you are going to the risk deviation to the 10, then you are expecting to get 50%. As I mentioned to you, return is enlarging as much as the risk factor is also. But this is very dangerous game. And when you are promising for 75, then the risk is also very high, as you are observing here. Therefore, you don't have to risk that much for making risky business. The asset valuation is also important in the economy. The fundamental analysis is used for estimating and analyzing the any asset or any fundamental application. Is the study of company accounting statements and future prospects to determine its value. The fundamental analysis is used for calculating the asset's estimated value. And the people can employ fundamental analysis to try to determine its stocks, whether it is underestimated, overestimated, or fairly estimated. We are much better or prefer to get some underestimated and sell it to the overestimated to get some profit. I hope you are understanding. If it is lower valued, then you will buy something in the stock market especially, and then you will sell it when it is overvalued. Therefore, it is better to get fairly valued, then this will not risk you. But if some values or some assets, some stock papers is undervalued, then the brokers maybe inform you it is reduced, just buy it, and after 2 months maybe it is overvalued, and you will sell it and you get these percentages as an interest, as a profit. And the goal is to buy undervalued stock and sell it to the overvalued, as I mentioned to you. The efficient market hypothesis. The efficient market hypothesis is the theory that asset prices reflect all publicly available information about the value of an asset. This is supposed to be that we are getting some market hypothesis and market random information is given to you for some markets. As you are observing here, the market is informally efficient when it reflects all available information in the rational way. If it is not, then it is randomly realized. Therefore, we are expecting that we get to all information efficiently for getting the sufficient information for buying some assets. Therefore, it is not reliable information when you are getting some portfolio, some stock papers with the inefficient information or inefficient information. If markets are efficient, the only thing an investor can do is to buy the diversified portfolio, as it is expected, isn't it? Therefore, the random walks refer to the part of variable whose changes are impossible to predict. Random walk is suggested that you are doing something casually, randomly, and it is of course not realized approach. If markets are efficient, all stocks are fairly valued, and no stocks is more likely to appreciate than other. Thus, stock prices follow a random walk, which is not acceptable. The given knowledge to you today is dependent to the financial markets, and savings can earn interest. A sum of money today is more valuable than the same sum of money in the future. Therefore, you have to determine whether you are going to invest to the future will generate too much money to you, or you are going to use it today because your capital is depreciating very easily as Turkish lira, and it is better to invest, to buy, let's say, real estate investing is instead of investing. Because if you put your capital for 4 5 years or for 10 years interest rate, probably your capital will lose money, will lose its value very faster than your interest which you are going to get. Therefore, you have to determine whether you are going to consider the present value and use in present, or you're gonna put the future value because you know that in 10 years you will get better capital. Therefore, you wanna invest and save your capital for the future value for 10 years period of time. These things is given to you shortly and briefly today, and you will then understand probably how it is going to manage the capital and whether it is profitable or is risk averse, or there is some risk diversification and there is some risk to reduce, or if it is possible to do some analysis for managing our capitals for not losing its value or generating some profit. The present value of any future sum is the amount of that would be needed today given prevailing interest rate to produce the future value. And if the future value is higher than the present value, you will do this. And if it is opposite, then you will not do it. You will prefer to do the present value, as I said to you. And diminishing marginal utility, most people are risk averse, as I mentioned to you. And risk averse people can reduce the risk by using or buying some insurance, by diversifying its production or products, and choosing some portfolio with lower returns is also possible, acceptable options. The value of an asset, such as share of stocks, equals the present value of a cash flow that owner of the share will receive, including the stream of dividends and the final sale prices, is also possible in the asset management. And according to the efficient market hypothesis, financial markets process available information rationally, so the stock price always equals to the best estimate of the value of the underlying businesses. Therefore, it is better to buy some underestimated asset and sell it to the over when it is become overestimated. Some economists question the efficiency market hypothesis, however, and believe that irrational psychological factors are also influence the asset prices, because some speculative actions and activities, especially in the government, affecting the market very heavily. As you are observing currently, we are having very heavily in our markets. If the problem between the central bank president and the prime minister or the president, this will then affect the stock papers price, or the market interest rate is very heavily affected, or the capital or the interest rate, currency valuation affection or inflation will go faster on these speculative speech or treats. This was the today's class. If you have any question, you ask me. If you don't, then I will finish this for today. Do you have any question? No question?
I got no questions.
Okay, then see you then next week. If you have problem with your results, you ask me, then I will help you. I will tell you results. Or if you already know your results, then no problem. We will go to the next class next week. Yes, I'm listening.
Concerning about the last exam, I
Yes.
did not finish it. I told you about it.
Mamadou, you are talking.
So, you said?
OPM, OPM.
Yes, it's OPM, yes.
Yes, what did you ask? What was the question? Your exam result?
I did not finish the exam. I told you about it.
You didn't finish, but you sent me your results. You sent me your answers.
You said? No, I did not submit it. I did not send you the answer. I was unable to build the question. I told you about it.
Yes, but did you submit your email? Did you submit it via email? You submitted your exam, you said, or you didn't submit?
Alpha.
You didn't submit your exam, you said. OPM. Do you hear me? I think he quit. I don't know. Is anybody? Did anybody understand what was the question? Did you get his question?
Yes, sir. That he said he's unable to submit his exam.
Yes. Yes. Then I told him to submit it via email. The answers. He should submit.
I think he submitted it by his email.
Then I will control it and evaluate it. If is there anybody who didn't submit also? OPM. OPM Ademosu. Okay. And anybody else? Everybody submitted?
Yes, sir. I submitted mine through email.
Ayuk Sema?
Yes, sir. Yes, sir.
Okay, I will control it. Did you submit to university email?
Yes, through Microsoft Word. Software.
Okay, about email, isn't it? You submitted to the email.
Yes, sir.
Okay. Is anybody else who didn't, or is that all only? Only OPM and Ayuk Sema. Is that all? I think OPM quit, or he had experienced some disconnection problem. Anyway, I will control and give you the results. Okay, if you know your results, is okay. If you don't know your results, please let me know. Then I will write you. You know your results. I think you know your results, isn't it? You have seen your results.
Yes,
okay,
sir.
then. Okay, then I'm going to finish this class today and see you next week. I think next week there is a holiday, isn't it? There is a Ramadan Bayram, isn't it? Or there isn't? We have, I think, next week class on Monday, isn't it? But on Friday we don't have it. Okay. On Monday we have class with you. Okay, then there is no problem. Okay.
Okay, sir. Thank
Next Monday we have class, but on Friday we don't have it with the other group. Okay, then see you on Monday.
you. Okay, sir. Thank you.
Have a nice week. Bye bye.
You too have a nice.